Should you save your emergency fund in cryptocurrency? You should be saving an emergency fund just in case something goes wrong, whether you lose your job or another main source of income, so you're just not left out cold on the streets. The problem is that most places to store your money are suboptimal at best. When you're done watching this video, you will know all the reasons why storing your money in banks is probably not the best idea, and why you might want to consider storing your emergency fund or other savings in cryptocurrencies instead. So, lovingly, gently, tenderly, smash that like button for the YouTube algorithm, and like and subscribe to this channel, and let's get started. You are watching Finance Squared, and I'm your host, Derek West. On this channel, we love talking about all things personal finance, and savings and cryptocurrency are definitely up there in terms of topics we love to cover. Saving is very important to any financial independence plans that you may have. Don't let anybody fool you. No matter what path you're likely to pursue, whether it's starting your own enterprise or investing your way to financial independence, you will need some level of capital to get it all started. Even with the advent of all these low barrier to entry side hustles, you are going to need a little bit of money to get started. If you're setting up a Shopify store, if you have a store for more than a month, that is, to get past their free trial phase, you're going to need to have some kind of cash to pay for that, not to mention all the costs for the additional add-ons and apps that you're going to want to have. Now, if you're not artistic at all, you're going to want to invest in someone to help you make your store look presentable to the general public. You're going to want someone to maybe help you with specific customizations for your specific needs and niche. If you're starting an Amazon store, this is especially true. For Amazon, you need to have inventory to be able to fulfill orders to customers. Inventory is not cheap, and it can be very expensive to get started, meaning anywhere from $500 to $50,000 worth of inventory. And as I'm sure you know, that is not cheap. If you're going to be doing an Uber or Lyft type side gig, you're going to need some money as well, not only to purchase a car, but to maintain that car and help keep it clean and ready to rock, so that when customers get in, they aren't completely disgusted with the state of your 1998 Dodge Neon and how dirty and musty it is. Now, I know that at some point in the past, Lyft at least helped you to lease or purchase a car to drive with them. I do not know if that is the case anymore, but it was in the not so distant past. That said, nowadays, it only costs you a fraction of a dollar to invest in stocks and bonds and things like that, thanks to apps like Robinhood. But if you spend every dime, the second you get it, you'll not even have any money to do that. And we're not even talking about saving up for your investment or entrepreneurial future. You should, at a minimum, be saving your emergency fund, so that in the event that you lose a job or your main source of income, you'll have something to fall back on without having too much stress to help pay for your day-to-day needs, while at the same time not dipping into your investments or future retirement money. So yes, saving money is critical, but what vehicle should you use to save your money with? Banks and savings accounts. So longtime viewers of my channel, which is not even a year old yet at the time of production of this video, but if you've been with me since the beginning, you know that I'm not a huge fan of savings accounts. Most savings accounts have a very low interest rate associated to them. If you're putting your money into them, with a standard inflation rate of 2%, you are likely losing money year over year and are not saving what you think you are. And I'm talking with the standard inflation rate. In the next few years, based on all the stimulus that has been passed in the last 2+ years, and the additional stimulus that is planned, expect inflation rates to go crazy. Some folks even speculate that hyperinflation is going to rear its ugly head. But with inflation rates set to go absolutely berserk in the next few months to years, putting your money in a vehicle that will only give you back 0.14% will definitely not make any sense. Then there is your standard high yield savings checking or CD type accounts. These are absolutely acceptable as alternatives for now. Depending on how inflation goes, accounts like this may become even more attractive to savers. When high interest rates go up is typically when high yield savings accounts make the most sense. And with high inflation, the standard response is to raise interest rates. So high yield savings accounts will probably make sense in the very near future. And that stated, even today, these accounts are great places to put your money, since they get close and sometimes exceed the standard inflation rate of 2% per year to you. However, like I just mentioned, inflation is set to go up the next couple of years. Will these type of accounts make sense if inflation is at 10% per year? What about 15% per year? Actually, at those type of inflation rates, most anything doesn't make sense. Then there are bonds. James bonds. Bad joke. Bonds are a great way to invest your money while smoothing out the volatility of stocks and other highly volatile assets. And ordinarily, this is a great place to put your money. But bonds are really more of an investment vehicle, not really a savings vehicle. And remember, we're talking about saving up for your emergency fund. That is, funds that you should have immediate access to in case stuff hits the fan and you need cash quickly. You don't want to wait for your bond to hit its maturity date before you can pull cash out without losing too much money. Bonds are ideally best in a portfolio that has been split based on your retirement horizon. If you're playing your investments moderately conservatively, that is. In other words, you're invested in a broad market index fund with about 80% of your investment holdings in that index fund or ETF. And you're also holding bond market ETFs or index funds for the other 20%. If you are in your 20s, The percentage of bonds in your portfolio will go up as you age, and the percentage of equity ETFs will go down as you get close to retirement, since you don't want your retirement nest egg to drop by 20% or more during a market crash. But remember, bonds are safer than stocks, but they are not risk-free. Bonds are effectively you loaning out your money to some entity, either a corporation or entrepreneurial venture, or to some kind of government. It is possible that either corporations or governments can go broke, and they're unable to pay their respective obligations, and you take it in the shorts. I would be very leery about loaning out money, in other words, buying bonds, from governments that are known to default on their obligations, i.e. Greece, or corporations that are unproven. That is actually a video topic in and of itself. But yeah, bonds are not exactly ideal for emergency fund savings. What does a spendthrift to do with most of their choices limited by the reasons above? Well, there is another asset class that has been rising in popularity over the last couple of years that may, just may, be able to be a good store of value during the inflated times we are all living through. That would be cryptocurrency. Now, I know what you're thinking. Aren't you a cryptocurrency skeptic? Don't you think that cryptocurrency is mostly just vaporware? Don't you feel as though cryptocurrency is going to go through a major correction in the coming years? The answer to all those questions is yes, yes, and yes. Let me address each of those points and why I would still make an argument that cryptocurrency is a good place for your money as a vehicle for emergency savings. Am I a cryptocurrency skeptic? Why, yes, I am. Of the cryptocurrencies that are announced and live for the public to use, frankly, I feel like they leave something to be desired. Namely, their gas fees for transactions and their latency response times, and make them places to store value rather than transfer value, which a functioning currency should be good at. But notice what I said. Their deficits right now make them a good place to store value and not transfer value. Well, think about it. That is exactly what you want to do with your emergency fund. You want a place that will store value and maybe even increase in value, and again, not lose value over a significant period of time. Cryptocurrency, like the king of crypto, Bitcoin, are among the best stores of value out there right now. There are a few others that would make good stores in my opinion. Litecoin, Flipcoin, sounds like a topic for another video, am I right? Like and subscribe. But when you're saving up cash for an emergency, you don't necessarily want it to be extremely accessible either. You do want it to be able to use it when you have to, but you don't want to have to wait for 2 years for a bond to mature or something like that. And the slow latency of some of these cryptos represents a good and happy medium, making the currency useful enough to actually be used in actual transactions, but just slow enough to not be used every day. Another one of my criticisms of cryptocurrency is that they're mostly vaporware, right? Well, yeah, they are. I am a technologist, folks, and I'm just going to keep it real with you. Most cryptocurrency is flat out vaporware. That is, it is functional and it does what it says it's going to do. Mostly. I just don't think that what it is doing is very valuable in and of itself. Not to the level that people are treating it anyway. I don't think that the pricing levels in a lot of these cryptocurrencies is justified. I think quite a few are way overpriced. And again, that is another great topic for another video. But generally speaking, if you buy a stock or a company bond or something, that stock is from a company whose goal it is to sell a good or service to a paying customer. If you buy an ETF or an index fund, you're purchasing an equity or fund who is, by proxy, purchasing a stock. That stock is issued by a company whose main goal it is to provide a good or service to a paying customer. If you purchase a futures contract, that contract is to help smooth out the prices of typically a commodity that a paying customer is looking to get their hands on. If you buy a derivative, any type of derivatives, and there are many types of derivatives that instruments derive their value off of, that is an artifact from a company whose main goal it is to provide a good or service to a paying customer. Starting to see the trend? When you purchase a cryptocurrency, you're buying an asset that is a decentralized token useful for trade, or at best a smart contract, or even better than that, a smart contract that also helps to solve crypto governance, scalability, and latency issues. But are you purchasing a good or service? Are you purchasing something from someone who's providing a good and a service? Are you purchasing something that will help someone, something, some entity provide a good or a service to someone or something else? Generally speaking, no, other than a means of value transfer. Ask yourself honestly, what is it that is driving the value of cryptocurrency other than hedging against inflation? And remember to answer that honestly. But again, notice what I said there, other than hedging against inflation. I think for now, in the next couple of years, with inflation set to be crazy or absolutely insane, cryptocurrency will make a fine place to hold your money. Even if those cryptocurrencies lose up to 20 to 40% of their value, if and when people realize that they aren't really investing in anything. Which takes me to my next point. I think that cryptocurrencies are going to go through a major correction in the next couple of years. I will predict that about 20% or more of the value of cryptocurrencies will be lost over that time period, due to the fact that more and more people will wake up to the fact that, they're not really investing in anything except decentralized ones and zeros. I do think that is the case. So that means that I think cryptocurrency is going to have a major reckoning. But that does not mean that I don't think that cryptocurrency isn't absolutely revolutionary. and that it has a chance to revolutionize everything from banking to stocks to credit, all of it. But I also think that in the near term, with inflation looming, it will hold enough value to justify putting your money into it as a place to keep for emergency purposes while you invest in other things. It will of course take a lot of research to understand which cryptocurrencies are the ones you want to put your money into to help to stave off the ravages of inflation, all the while staying stable enough and even growing, which is the main reason why you should be subscribed to an informative yet entertaining personal finance channel that doesn't pull back the punches, but tells you like it is about all your favorite topics, including cryptocurrency. Start by subscribing to this channel and turning on post notifications so you're there when all our great videos drop. And while you're in an engaging mood, be sure to like this video if you liked this video, and drop a comment in the description of whether or not you think that putting your money into cryptocurrency as your emergency fund makes sense, or even if that's something that you're willing to do. And remember, a goal without a plan is a wish, and a goal with a plan and no action is a wish list. Take action on your personal finance goals by starting your emergency fund and maybe having it be mostly crypto. And I'll catch you guys next time. Peace.